All right, let's just jump right into it. That market drop we saw in early 2026, it left a lot of people just scratching their heads, right? So, in this explainer, we're going to break down what happens, why it happened, and most importantly, how you should probably think about investing now.
And really, this is the million-dollar question, isn't it? I mean, we're always told that certain assets are safe havens. When stocks go down, bonds or gold are supposed to be your safety net. But this time, everything tanked. At the same time, it really felt like there was nowhere to hide. So, what was actually going on?
To get it, we first have to really look at the event itself, what a lot of people are now calling the everything is sell off.
So, the conflict overseas kicked off. Oil prices went through the roof, and suddenly everyone was terrified of recession, of stagflation, and the market's reaction was, well, it was instant. Stocks, bonds, precious metals like gold, even crypto, they all just took a nosedive together. And that is a really rare and frankly a pretty scary thing for any investor because it basically broke all the rules we thought we knew about diversification. So, to find out why this happened, we've got to look a little deeper. We need to look at the very foundation of our global economy. And here it is. This is the key. The market's wild reaction, the long-term trends, pretty much all of it comes back to this one single, incredibly powerful idea. Our entire global system is built on an absolute mountain of debt.
And I mean a literal mountain. Just look at these numbers. 25 years ago, global government debt was sitting at around $20 trillion. By the end of 2025, it had exploded to over $111 trillion. This isn't just some small uptick. No, this is a fundamental change in the entire world's operating system.
Now, here's where it gets really interesting. When you have that much debt, the system actually needs inflation to keep going. It's not a mistake, it's not a bug in the system, it's a feature. The economy has to have rising wages, rising prices, and rising asset values just to keep the whole thing from collapsing under its own weight.
And this is a brilliant way to think about it on a personal level. Okay, imagine you've got a $300,000 mortgage. If your pay gets cut, that debt suddenly feels totally crushing, right? But what if your pay goes up over the years? What if it inflates? Well, that same $300,000 debt becomes much, much easier to handle. Our global economy is working on the exact same principle, just, with trillions of dollars. Okay, so we know the world runs on debt and kind of needs inflation. But what was the actual trigger for the sell-off? Well, it was a domino effect, something we call a margin call cascade. First, let's just make sure we're on the same page. Margin debt is super simple. It's money you borrow from your broker so you can invest more. It's leverage. And it's great when the market goes up. It can supercharge your gains. But if the market goes down, it can absolutely annihilate you. And that is exactly what happened. Here's how the dominoes fell. The market dropped, and it dropped fast. That triggered what are called margin calls. Basically, brokers calling up investors and demanding more cash right now to cover their losses. This sent investors scrambling to find cash, and the only way to get it fast was to sell their assets. And that creates this forced sell everything moment. This quote just nails it. When there's a cash crunch like that, you don't have the luxury of picking and choosing what to sell. You can't sell your house in 2 days, but you can sell your stocks, your bonds, and yep, even your gold. People had to sell their most valuable, most liquid assets, and that's why even the so-called safe havens went down. All right, now that we get the short-term panic, let's zoom out. Let's look at the long-term predictable path that the system is on. So here's the really crucial part. Those short-term shocks, they're scary, but the system is programmed, it's designed by math, to return to its default setting. And that setting is more money, which creates more inflation, which over the long run pushes the price of assets higher. And you can see that design right here in the data. This chart shows the money supply. It's not a straight line, is it? It's a curve that's getting steeper and steeper. The amount of money in the system just keeps expanding, and it's doing it at a faster and faster rate. That is the engine of long-term inflation. So is it really any surprise that the stock market chart looks like this over the long haul? All of that new money has to find a home somewhere, and a whole lot of it flows right into the stock market, pushing prices up. It's a direct result of that expanding money supply. And it's not just stocks. I mean, look at gold. The long-term trend is exactly the same. Why? Well, it's simple. As more dollars get created, each one of those dollars is worth a little bit less. So it just takes more and more of these weaker dollars to buy the same ounce of gold.
This is what inflation looks like in its purest form. Okay, so we've figured out the why. We live in a debt-based system that is engineered for inflation. So what in the world does that mean for you? How do you actually invest in this kind of environment? Let's put together a simple playbook. Here are 4 key principles. Number 1, stay invested. The long-term trend is clearly up, so trying to jump in and out of the market is just a loser's game. 2, use these scary moments to your advantage. Buy the dips. Use dollar cost averaging to take the emotion out of it. 3, and this is so important after what we just saw, avoid excessive margin. Do not let a margin call force you to sell everything at the absolute worst time. And 4, diversify the right way. Own US stocks, own international stocks, and own hard assets like precious metals. So I'll just leave you with this final thought. We've seen that we live in a world that is mathematically designed for long-term inflation. So the most important question you can really ask yourself right now is this. Is your portfolio built to not just survive, but actually thrive in that world?